Good afternoon. This is Chris Mangian, tax partner at V&E, focusing on real estate.
I'm Paige Anderson, also a tax partner and similar focus on REITs and real estate.
So the reason we're here today is to talk about some proposed regulations that Treasury released at the end of 2022. And those proposed regulations implement look-through rules for shareholders in determining whether a REIT qualifies as domestically controlled. And one of the themes here today is going to be to talk about how truly radical a proposal this is, specifically as it relates to looking through C corporations, which this is a departure from longstanding legal precedent and court cases dating all the way back to Moline Properties in the early 1940s. And those precedents have traditionally held that a corporation has a separate tax identity from its shareholders. This caught a lot of people by surprise, myself included, mostly because no one who practices in this area, at least that I'm aware of, thought that this was an area of controversy until the government proposed these regulations. So what we're going to do today is go through a brief summary of FIRPTA, the domestically controlled rules, the changes proposed in the regulations, some criticisms of the regulations, and finally, what it means for you going forward. So I will, in a second here, turn it over to my esteemed colleague, Paige, to take us through FIRPTA. And how do I know she's esteemed? Because she's got a lovely office here that looks uptown, and I am in a converted conference room next to the men's toilet. And so either, the office services people have been in touch with the same people who booked my airline tickets, or, Wally has arranged this as a prank on me. So anyway, with that, I'll let Paige take it.
Okay, so most of our presentation will focus on the proposed regulations, which relate to a specific exemption from the Foreign Investment in Real Property Act of 1980, or FIRPTA. So before we dive into that, I'm just going to go through and kind of briefly set the stage for those of you who may be a little less familiar with FIRPTA and how it works. As a general matter, foreign investors are exempt from U.S. tax on capital gains from their U.S.-based investments. FIRPTA is a significant exception to this rule. And what it does is for certain gains realized in connection or income connection with investments in what are known as U.S. real property interests, those are subject to tax at the same rates applicable to U.S. taxpayers as if the income was effectively connected income of a foreign taxpayer. In addition to this net income tax, foreign corporations may be subject to a 30% branch profits tax. And there is a withholding regime that applies at a 15% of gross basis. So what's taxed under FIRPTA? It applies to U.S. RPIs, United States Real Property Interests. This is any interest in real property in the United States or Virgin Islands, but also includes any interest other than an interest solely as a creditor in a United States Real Property Holding Corporation. And that's going to be kind of our focus here when we get to the exceptions. U.S. RPHC is a corporation. The fair market value of the U.S. RPIs it owns is at least 50% of the sum of essentially all its assets. So any corporation that has a significant amount of real property, your equity REITs are going to be almost without exception U.S. RPHCs. And when you determine whether a corporation is a U.S. RPHC, you have to look at a holding period that's the shorter of the relevant taxpayers holding of the stock in the corporation, and the 5-year period ending on the date of the disposition. So there are, in addition to the exception we'll focus on today, various exceptions. The publicly traded exception applies to minority interests in publicly traded stock. There's what was known as a QFPF exemption, and that exempts qualified foreign pension funds from FERPTA. That's a relatively new addition, and there's actually some regulations associated with these QFPFs that came out at the same time as the regulations we'll focus on. A qualified shareholder exception is another newer exception for certain foreign investors with respect to REITs only. Foreign governments, otherwise you might hear these referred to as 892 investors, if they do not control the US RPHC in question, they are not subject to tax on the sale or exchange of interests in that corporation. And then what we will be focusing on today is the DC QIE exception, which exempts foreign investors from FERPTA on the disposition of stock in what is known as a domestically controlled qualified investment entity.
Yeah, so before we leave this slide, just one little nugget on the publicly traded exception. That's essentially going to be for stock that's traded on an exchange. There are some bills out there floating around that would expand that treatment to so-called public non-listed REITs. Not sure what the likelihood of those being passed is, but there's a proposal floating around on that.
So diving into the DC QIE exemption, a QIE essentially means a REIT or a regulated investment company that either is a US RPHC or would be a US RPHC, but for the application of the publicly traded exception. For the exception to apply, the QIE must be domestically controlled. And that means that all times during the applicable testing period, less than 50% of the fair market value of its outstanding stock is held directly or indirectly by foreign persons. The testing period is slightly different here. It is the shorter of the 5-year period ending on the date of disposition of the QIE stock or a distribution by the QIE, and the period during which the QIE was in existence. So this focuses on the QIE itself and not the ownership of a foreign person. So a foreign investor could buy into a DC QIE and benefit from the exemption, even if it has held its stock for less than 5 years. But conversely, that same investor does have to look back prior to its ownership. So if any time during the testing period before that owner invested, it wasn't a DCQIE, it isn't with respect to that owner. The key part of this exception that the proposed regulations focus on is the meaning of directly or indirectly. And that there's really no guidance in the code or the legislative history on what the meaning of that is.
Yeah, and that's as you'll see in a minute, that's the perceived vacuum that the Treasury has stepped in to fill. So this is not a situation where we are looking at regulations being issued with respect to the interpretation of a new statute. This directly and indirectly language has been in the code since 1980. And in 1984, the Treasury set forth Regulation 1.897-1C21. And this says that for purpose of determining whether a REIT is domestically controlled,
the actual owners of stock, as determined under Treasury Regulation 1.857-8, must be taken into account. And that rule, which is quoted in full in the slides, says that the actual owner is the person who is required to include gross income from the investment in the dividends on the stock. So this has been interpreted to say that a C corporation is a fully taxable entity, which would report the dividends received in its income, is an actual owner for the purposes of the DCQIE exception.
So basically, if it's you look to whatever person has to put it on their tax return, that's the owner essentially, is what this rule is saying.
So, you know, with a domestic partnership, in contrast, it's generally been believed that you would look through a domestic partnership is not an actual owner because while it files a tax return, it's its partners that actually report the income. So that particular regulation does not actually refer to the words directly or indirectly, but conceptually, it's been thought to get you to the same point. The actual owner is direct or indirect owner. In 2009, the IRS issued a private letter ruling on this topic. Now, private letter rulings are only applicable to the taxpayer that they are issued to. You cannot, if you are not that taxpayer, you cannot technically rely on them. However, as a practical matter, practitioners have viewed this PLR as indicative of the IRS's interpretation of directly or indirectly. So the setup that you had in this PLR, as shown on the slides, REIT A was owned by three direct owners, which is B, a domestic C Corp, E, a domestic LLC that was disregarded for tax purposes, and F, a domestic partnership. E was in turn owned by C, a domestic C corporation, which also owned part of B. Both B and C were otherwise foreign owned. The IRS looked at this and said, although B and C have foreign owners, because they are domestic C corporations, A is considered 100%. A is not, B is a domestic owner. You do not look through B. And although you look through E as a disregarded entity, you do not look through C. So those two, for determining domestic control, those two red entities, they're B and C, you stop there. You don't continue to look through.
And that would be consistent with the regulation we just read, because it would be those C Corps that would put the dividends from the REIT on their tax return.
There are a couple other bases out there for practitioners believing that you do not look through a C Corp for purposes of the DCQIE exception. One is the lack of reference to Code Section 318. That is a provision that provides for rules of attribution between entities. It is used in certain places in connection with FERPTA, such as the publicly traded exception, a determination of US RPH status, and a few other areas. Courts have long held that when Congress uses specific language in a statute, but does not in another part of it, it should be read as purposeful. Further, Section 318 itself provides that it's only applicable where it's expressly made applicable. So since there was no reference to 318 in the DCQIE exception, it's generally considered that's a further basis for not looking through, not attributing stock ownership of a corporation to other owners.
Right. And I think when we get into the comments a little bit later, we'll talk about this, but several commentators have pointed out that the words directly or indirectly by themselves are used in multiple places throughout the code where constructive ownership isn't applied unless there are explicit constructive ownership rules that Congress has provided.
This history that we've gone through, including the 2009 private letter ruling, has been discussed by Congress both in 2013 draft legislation and in the PATH Act that was enacted in 2015. There's a proposal in 2013 to provide certain attribution rules that was never passed. And then in 2015, the PATH Act added a look-through rule when you've got tiered QIEs. And both of these are examples of the fact that Congress did not believe, that does not appear to believe that the legislation is currently stands, provides for a look-through, and that one would have to be enacted for success.
Yeah, to put a little bit of a finer point on that, a REIT is a corporation. And so if you think about it, if Congress felt the need to put in a specific look-through rule for one REIT that owns another REIT, by implication, they did not believe the statute and the language that said directly or indirectly meant you look through corporations. It would have been completely superfluous for them to do that.
So what does this exception look like as it has been interpreted up to the issuance of these proposed regulations? I have a few examples here. The first one is we have a REIT that's owned 25% by various U.S. shareholders and 75% by a domestic partnership, which is in turn owned 90% by foreign investors and 10% by U.S. investors. For determining the domestic control, since B is a partnership, you look through. Therefore, A is considered to be owned 67.5% by foreign persons and would not be domestically controlled.
Yeah, on this one, a couple other points. We said current law on the slide, but really what I would say is this is sort of current, tax bar practice, right? Because the IRS set up this structure in the preamble to the proposed regs as a straw man for these look-through rules. But I don't think I've encountered one time in my career somebody arguing that you stop at a domestic partnership for purposes of looking through to determine domestically controlled status. And so that was sort of a straw man that they were easily able to burn down in the preamble. But that's probably one of the items in the proposed regulations that is not controversial. They just confirmed what we all thought anyway, which is that you had to look through a partnership, but not a corp.
And so moving on to, we said current law, but current interpretation prior to these proposed regulations. We'll take the same setup here, but we'll change B from a domestic partnership to a domestic C corporation under the belief that you do not look through B and B is domestic. Now A is considered 100% owned by U.S. persons, 25% by U.S. shareholders, and 75% by B, also considered a U.S. person, and A would be domestically controlled. So where the perceived, I think called the perceived controversy here, or what the IRS seems to be getting at with these proposed regulations, is that it has been a practice to take these rules and use a domestic C corporation as a blocker to create a domestically controlled REIT. So here is an example. You have REIT A directly owned 49.9% by foreign investors And the other 51% is ultimately you have foreign investors, but you have a domestic C corporation as a blocker there. If you don't look through B, A is more than 50% owned by US persons and is considered domestically controlled. And this was generally not believed to be abusive because there is an actual tax cost to it. B pays tax on the dividends it receives from A, just as any other US person shareholder would.
Yeah, but the sort of goal of this structure, right, is you're going to pay tax on the dividends and the gain on sale on 50.1%, but this other 49.9% goes out of the country tax free.
So what do the proposed regulations do? Compared to a lot of regulations that come out of the IRS, the proposed regulations are actually quite short and simple, but cannot kind of overstate their impact on this area. The proposed regulations would provide that you would look through the following entities: domestic and foreign partnerships, REITs, RICs, and foreign-owned domestic corporations.
And on the foreign partnerships, that was actually a helpful clarification in my mind, because there was at least some question out there as to whether you had to stop at a foreign partnership or look through to its owners.
Yes. The focus here and what has gotten everyone concerned is this look through of what is a foreign-owned domestic corporation. The proposed regulations define that as any non-publicly traded domestic C corporation if 20% of the fair market value of the corporation stock is owned directly or indirectly by foreign persons. Another aspect of the proposed regulations, they confirm that while a QFPF is not subject to FIRPTA under one of the exemptions we talked about previously, a QFPF is treated as a foreign person for purposes of the DCQIE exception.
Yeah, and on this one, I had heard anecdotally that there were people out there in the market making the argument that a QFPF was to be treated as domestic for purposes of these rules. I always thought that was pretty aggressive and never saw it personally, just heard about it. But this would put an end to that argument.
Right. And the reason why that would be aggressive is that it would be taking the benefits extended to QFPFs with the exemption and allowing a QFPF to effectively help a non-QFPF foreign investor take advantage of the DC QIE exemption. If that were true, your REIT could be owned 50%, 51% by a QFPF and 49% by other foreign investors and be domestically controlled. And Lyra said, no, that's not how this works.
While in reality being 100% foreign.
No, yeah. The proposed regulations would apply to transactions occurring on or after the date of publication of the final regulations. On its face, that doesn't sound that unusual, but the regulations would be effectively retroactive because of the testing period is a 5-year look back. So say, the regulations go into effect, you're to all of a sudden you're no longer DCQIE exception under the regulations. Well, that's going to apply for 5 years because you have to apply the new regulations to the whole look back period, the way the IRS put it out. In addition, and this is highly unusual, the IRS said that they may challenge positions contrary to the proposed regulations prior to the publication date. And that's despite everything we've talked about, the belief that you don't look through the private letter ruling and all that. They said, well, we may still challenge it now.
Yeah, this is outrageous. they haven't pulled the regulation. They haven't withdrawn the private letter ruling. I mean, this is, sort of an interim statement, right? Where they've just, I think what they're really trying to do is warn people not to plan into this structure between the date of the proposed regulations and the date that they're finalized. But certainly the way that it's worded makes you feel like they think this is the law today, which is pretty outrageous given the authorities that are out there.
So how would these new regulations work? We've illustrated here two of the examples that are in the proposed regulations. Here, first, we have USR, a REIT that's 49% owned by foreign persons and 51% owned by a publicly traded domestic C corporation. Because X is publicly traded, it is not looked through under the proposed regulations. USR is considered 51% domestically owned and therefore is a domestically controlled QIE. This is in the proposed regulations, but would not be a change from the way the rule is currently thought about.
Yeah, just because the C Corp is public in this case, you get the same result that we would have thought we always would get.
Exactly. But now in the next example, we take X and we make it not publicly traded. Under these rules, because X is not publicly traded, we can't necessarily stop at X, and we have to figure out whether X is more than 25% foreign owned. So if we look at in the example, X, they have 75% owned by US persons, 5% owned by Y, a non-resident alien individual, and 20% owned by FC, a foreign corporation. Because Y and FC together own 25% of X, under the regulations, we would be required to look through X. In this particular example, we do get to stop with Y and FC. We don't have to look through them further. And so we apply their ownership as if they own directly in USR REITs. You've got FC1 being considered to own 10.2% of USR, Y 2.55%. And now you add that to the 49% direct foreign ownership, and you have 61.75% foreign ownership, and USR is no longer considered domestically controlled.
Yeah, and a couple more points on this one. I am aware, and others are aware, of situations where this really produces an unfair result. As a matter of fact, there are a couple of prominent insurance companies that do a lot of real estate investing. They're US corporations with thousands of employees and have been paying taxes here for decades, but they are private and they are majority foreign owned. And this is just an example of how overly broad these rules are, that a company like that would get caught up in these rules, and it just doesn't make sense.
Right. I think the preamble talks about, the blocker structure essentially that I showed you earlier, and seems to be focused on these kind of, what they're thinking of as like synthetic, right, domestically controlled REITs. But there are domestically controlled REITs that were not created in such a manner that would be picked up by this regulation.
Right. It's the old, using a sledgehammer to kill a fly. So now I'm going to talk about some concerns and comments with respect to the proposed regs. We've touched on some of these along the way. First is really just inconsistency with existing law. You've got the private letter ruling out there. You have the regulations out there. You have the PATH Act, where Congress put in specific rules for REITs to look through parent REITs. and you have the legislative history where Congress specifically considered a look-through rule for C corps and declined to include it in the PATH Act. If you look back at the 2013 discussion draft where that provision was discussed, it had basically all of the provisions of the PATH Act in there, and then the PATH Act is adopted without that particular provision. So I think it's really hard to argue that this interpretation is consistent with congressional intent. You've also got some arguments about whether these regs are even valid. I will get to some more detailed discussion on that in a couple minutes. One of the big concerns we've been hearing is around administrability of these rules. You know, these charts we've shown you in this presentation are kind of simple and good for examples, but you know, you guys all know in the real world, there are, you know, layers and layers and layers of partnerships and corporations in a lot of structures. And there's questions about whether people would even be able to get the kind of information from investors that they would need to make these analyses. And even if that information exists, will your investors, you know, be willing to share that with you? You've also got, you know, just another administrability concern. If you've got sort of a widely held but not publicly traded entity, you know, how do you go about getting information from all these people? Will people respond? Will they not respond? There's a chilling effect of the regulations, as Paige talked about earlier. There's a 5-year look back to determine domestically controlled structure, and so you know, even if you said today, okay, well, I think the regulations are going to be finalized as they're currently written, and you restructured yourself tomorrow to be domestically controlled under the new rules, you would theoretically have to wait an additional 5 years from tomorrow before you could once again be domestically controlled. And we'll talk a little bit about whether there's going to be any transition relief in a minute, but that's the way the regulations read as of today. And there's uncertainty around how do you structure new investments. You know, I think you have to assume for the time being anyway that that the synthetic structure that we showed on one of the earlier slides is dead for the time being. There's economic costs involved. If you choose to restructure, there's transaction costs involved with that, including potentially tax costs of those restructurings. There could be fire sales. I mean, you know, if the regulations are finalized as written, you know, one of the solutions that doesn't involve sort of engineering of some kind is to just find more U.S. investors to invest in your product. And, you know, if you believe in the efficient market, the U.S. investors are going to know that you need more U.S. investors. And that also happens to be, you know, not where the capital is coming from, at least today. And so could you wind up in a situation where in order to get to domestic control, you've got to sell at disadvantageous prices to U.S. investors? And then, of course, just generally reduced foreign investment in U.S. real estate, which is something we can ill afford at this time in this interest rate environment. You know, one of the things that, you know, foreign investors like about coming into the U.S. is we have a stable regulatory regime, and you know, things don't change unpredictably. And I think this is, you know, if it were me, this would make me think hard about investing in U.S. real estate, because this is a change that was done outside of the normal process, in my opinion. In my opinion, this needed to be done by Congress, and it's been done in a regulatory manner and in a way that is unfair, in my view. So as you could probably tell from my comments, Paige and I participated in the ABA comment letter on this, and there are a bunch of other industry and trade groups that sent comment letters to Treasury as well. And those comments uniformly requested that at least a portion of the proposed regs around the look-through of C Corps be withdrawn in its entirety and the conclusion of the PLR be affirmed. You know, we also in the ABA letter suggested some alternative approaches in an attempt to be constructive. Some of the industry groups did not recommend alternative approaches because I think the view there that I don't necessarily disagree with is that the regs are invalid, and even sort of suggesting alternative approaches is giving credence to them. But in an attempt to be constructive, we, in addition to asking for withdrawal, we asked for some alternative approaches were they not to withdraw the regulations. And essentially, I'm not going to read through all these, but what they're trying to get at is a way that you could address sort of the synthetic situation where you've got the same the same party that's the direct investor in the REIT and the indirect investor through a C Corp. These suggestions would generally require the C Corp to be a little bit more widely held in order to get the favorable tax treatment. And then the fourth one there at the bottom just really speaks to the insurance companies that I talked about earlier. It just seems patently unfair that a long-standing domestic C Corp with employees and business here would have to be looked through just because it's not publicly traded.
Right. Again, if despite the urging for the withdrawal, if we end up with this regulation, it gets to those insurance companies were not structuring into their exemption. It's a part of the nature of their business.
Yeah, we also focused in the comment letter on transition relief. Obviously, when you change things in midstream like this, transition relief is going to be important. And so we asked for generous transition relief. On one ask was, don't apply these regulations to any period of the 5-year look back rule that would be before the publication date. So essentially what that would allow you to do is say, okay, you published the regulations, I'll restructure, and then, the new rules apply to me going forward, but don't make them apply to me 5 years looking back when I didn't know you were going to change the rules. We also asked as an alternative for an exemption for REITs that were established prior to the issuance of the proposed regulations, again, under the theory that, if you do this structure after the publication of the proposed regulations, you were on notice and you should have known better. But if you did it before, how were you supposed to know they were going to make this change? A third one is to exempt foreign investors to the extent of their existing interests and capital commitments from periods prior to the proposed regulations. This one would be extremely difficult to administer, and I doubt we'll wind up there. Okay, so where will the government go from here? So far, there have been limited public statements by the government on these regulations, and what little is out there seems to be focused on their study of transition rules. I think they've heard the commentators loud and clear that this is a change, a midstream change, and so I think they're focusing on transition rules. The industry groups continue to exert pressure via their comment letters and press interviews. And then a few weeks ago, Rep. LaHood from Illinois, who sits on Ways and Means, submitted some questions for the record following Secretary Yellen's testimony in front of the Ways and Means Committee. And the way this works is if a member of the committee submits questions for the record, Treasury is required to respond to those questions in writing. And I'll just read the 2 bullet points here at the bottom. In developing this proposed regulation, what was Treasury's reasoning in suddenly altering long-settled tax policy under FERPTA that conflicts with congressional intent in this area? The second question, given the current challenges facing the real estate market, including rising interest rates, demand shifts, and supply chain disruptions, does Treasury have any available analysis that was conducted that would provide some explanation for this sudden shift in policy? I will be very interested to see the responses to those questions because I think we're all wondering where this came from. Likelihood of withdrawal, it's obviously hard to predict, but if I had to predict, I would say that the government will retain the look-through rule in the final regulations, potentially with a carve out for taxpayers like those insurance companies I talked about, and they'll provide some type of time-limited transition relief. I certainly hope they withdraw, but the realist in me thinks this is the most likely approach. Made reference a few minutes ago to the possibility of a challenge to the validity of these regs. There's a few different avenues that could be taken there. They all really focus on the fact that Treasury issued these regulations under its general authority and weren't specifically instructed to do so under FERPTA. So Section 7805 prohibits retroactive regulations. And as we discussed earlier, by their very nature of the 5-year look back, these regulations are retroactive, and they're potentially actually retroactive if you look at that statement in the preamble as the IRS saying, well, we think this is the law today. You could also make an argument that there's a lack of ambiguity in the current law, and the interpretation that they've made of the statute is unreasonable. And essentially, this would be sort of under the Chevron analysis. And, one of the things that we talked about, Paige, in preparing for this was, where did 25% come? Like, they pulled this out of thin air, completely out of thin air. It relates to nothing. And it's hard to understand where the number came from and why it's being used. You've also got something called the Major Questions Doctrine, which was recently cited in West Virginia versus EPA. And what that doctrine provides is that if an agency wants to decide an issue of major national significance, that action must be supported by a clear congressional authorization. It's in the eye of the beholder, I guess, whether this is an issue of major national significance. If you ask the Real Estate Roundtable and NAREIT, they'd say yes. You ask the man on the street, probably not. He'd say, what's a REIT? But you get the point. And the final point, validity challenges to this could be hampered by the Anti-Injunction Act. And essentially what that act provides is, this act is really the reason why when you sue over taxes, you wind up having to pay the tax and then sue for a refund. And so there really doesn't appear to be a hook here to sort of get standing as an industry group or as a financial sponsor without having someone, set up the structure, sell the REIT, pay the tax, and then sue for a refund. And that may result in a sort of a dearth of volunteers to be the test case for this.
Right. There's a case a few years back in the Supreme Court, CIC Services, and that had to do with an advisor challenging an IRS notice, and particularly a reporting requirement under that notice. And, the government said, well, no, you can't challenge this reporting requirement, this tax reporting requirement, without, having paid the tax. And the tax in question here was it was a penalty, a civil penalty, for not making the required reporting. And then there were also criminal penalties. And the Supreme Court said, no, in this case, the advisor can challenge without paying any tax, because what they're challenging is a reporting requirement. And in any event, if they were to not report and pay the tax, the civil penalty, well, they could also be thrown in jail for doing that. So that doesn't make any sense. Now, unfortunately, we've spent some time talking about this, thinking through it, looking through the FIRPTA rules, and we don't see a similar hook here. It really is income tax and withholding tax we're talking about.
So what are the impacts of this on a go-forward basis? So we'll talk about some things to be thinking about on existing structures first. Liability of withholding agents. So this would include both buyers of domestically controlled REIT shares, if there's sort of a direct transaction between the buyer and the shareholders of the REIT, or fund sponsors in the situation where a fund is selling REIT shares to a buyer. Either the buyer will have a withholding obligation under one set of circumstances, or the fund will have a withholding obligation on its foreign partners in another circumstance. You've also got actual tax liability under FIRPTA, including investor filing requirements for structures that don't already have a filing blocker. And if you thought that you were investing into a domestically controlled REIT, you may not have set your structure up to have a filing blocker. So not only do you actually have a tax liability, but now as a foreign investor, you have to file a tax return in the United States, which people really don't like to do. Side letters, I think everybody's client alert on this said, look at your side letters, but it is an important point. What have you promised your investors in terms of maintaining a domestically controlled REIT, and what level of efforts have you said that you would undertake to maintain that? Impact on syndication plans. As I said earlier, a lot of the appetite for U.S. real estate right now is coming from outside the country. And if you're a financial sponsor and you've got a REIT structure that you're trying to syndicate, this could really impact your ability to do that without giving up the domestic control of the REIT. And even if you don't have a problem today, do you have the information, or do you have the ability to get the information about upstream ownership changes that may occur in the future that could impact you? Again, there's a possibility that you would have to look through under these rules many, many tiers and layers of entities, and you may not even have the ability to get that information. So the action items, again, review your side letters, examine your existing syndication plans, and consider restructuring approaches. What's difficult right now is, without knowing what, if any, transition relief is going to be available, it's a little hard to restructure today, because you don't want to do it too early and restructure into a disadvantageous situation and then find out that there's going to be generous transition relief, or, even worse, the rule gets pulled from the final regulations and you went through all this trouble and expense and potential tax costs for nothing. Another approach is you could assume no transition relief, and assume you're going to have a 5-year waiting period, essentially that the regs will be finalized as they're written now. And, you could restructure today and start your 5-year clock today. You could consider having people move REIT investments into leverage blockers, but that's going to come at a tax cost, especially if the investment has appreciated, because it's going to be difficult to get debt back out of the blocker without triggering boot on the contribution of the REIT shares. A quick word about tax insurance as a solution, especially for withholding agents. The folks at Atlantic Global Risk were kind enough to speak to Paige and I last week and give us some insight on these matters. And I think we may have a couple of them in attendance today. But essentially what we're hearing is that there are policies available to insure against the risk for a sale that can be closed prior to the finalization of the regulations. However, there's very limited capacity for policies that would cover an actual change in law. So if you were to try to insure against the risk that the regulations will be finalized in their current form, that would be extremely expensive, and there's limited availability there. And certainly feel free to reach out to the folks from Atlantic Global with questions.
Yeah, I think I got another email from another provider this morning on, marketing these policies. So it does seem to be that there is a market developing for tax insurance in this area.
Yeah, that's right. And that could be a solution to bridge between, there's uncertainty right now in between. We've got the proposed regulations. We don't know when or if the regulations will be finalized, and if they're finalized, what form they'll take. And insurance can step in to plug that gap and allow transactions to happen in the interim. So I think this is our final slide. So with new structures, again, synthetic, domestically controlled REITs, if you're planning today, those are a thing of the past. I mean, you could theoretically still use a U.S. corporate blocker, but you'd have to have 75.1% domestic ownership. And that could be difficult to achieve, particularly to find U.S. investors that want to invest in real estate through a C Corp. Gather as much information as you can through investor questionnaires, and to the extent it's possible, secure the ability to get upstream ownership information. You could consider a leverage blocker structure for new investments. This works best if you're in a treaty jurisdiction that provides 0% withholding on U.S. sourced interests, Canada being one of those places. You could capitalize the blocker with debt from the foreign investor, equity from the foreign investor, so that they're not at or more than 25%. And then a U.S. investor puts in a smaller amount of capital, but an amount of capital that would get them to 75% equity ownership. This isn't a perfect solution because it distorts the economics versus where we were before the proposed regs were issued. Another idea that's not on this page as well is you could try, if you could get the math to work out, to use sort of a tiered structure where you have 2, 3, 4, even 5 REITs sitting on top of each other, and you're bringing investors with different characteristics into different levels. For example, you could put sovereign wealth and QFPF investors in a REIT because they don't need the REIT to be domestically controlled. And then you put FERPA sensitive investors and US investors on a REIT that's on top of that in the structure, and try to solve the math to get that specific REIT that's on top to be domestically controlled. What's complicated about this is when you do an exit, you've got to sell REITs at multiple different levels of the structure, which is going to be very complicated and potentially disturbing to a buyer. But people are taking this approach as one way to work around if you can get the math to work out with your investor base.
And you still have to be monitoring ownership on an ongoing basis to make that work.
Absolutely. So I think with that, we've made it through, and we started a few minutes late. So happy to hang around for a few minutes and answer questions. And find out if Schwartz's team got clean silverware after that accident back there earlier.
So it looks like I have a question that came in from online asking whether this would apply to REITs that have JVs with foreign partners. If we're talking about JV below the REIT, like if the REIT is entered into a JV with a foreign partner, probably not. It would depend on particularly how that JV is done and whether that JV itself has like a baby REIT.
Yeah. If there's a baby REIT underneath it, then yes. But if the foreign investor has come in through another blocked structure that's just on its side, then probably not.
Then probably not. You're going to be okay there. Point that now, if you're talking about a REIT with the JV above it, the regulations do say you do look through whether it's foreign or domestic JV above it. So you would have to continue to look through that.
Yeah, and depending on who the investor is, right? If they're FERPTA sensitive, that could be a problem if they're 892 or QFPF. QFPF, it doesn't matter how much they own. If they're 892, they just can't control the JV, and it doesn't matter if the REIT is domestically controlled.
Do we have any questions here in New York?
Yeah, so the question was, when do we expect to see a response to Representative LaHood's questions to Treasury? And the honest answer is I have no idea. I know they are required to respond in writing, but I'm not sure if there is a timeline on that. But we will definitely be monitoring it.
One thing that's tricky with the IRS and regulations, I mean, in this is talking more about the regulations than the response, but it could very well, be relevant to the response is that, I mean, there's no timeline from proposal to final regulations. I mean, there
are proposed regs that have been out there for 15 years.
Right. I mean, so we could be sitting with these, for a really long time. It would be bad. Yeah. But it is, we hope that with the attention that this is getting and the potential impact that, ideally the IRS withdraws, but whatever they do, we want them to do it quickly, but there's no mandate or timeline.
Yeah, I mean, certainty, even if it's bad certainty, would be better than just letting this hang out there for a decade and have people try to figure out what to do. Okay, should we wrap it up?
Sounds good. Well, thank you all for
Thanks,
coming.
Guys.